Today, the U.S. inflation rate is 3.3%. Now, that's high, but much lower than the country's peak inflation level of 9.1% in 2022, during the fallout of the COVID-19 pandemic. Wage growth is slightly outpacing inflation, meaning Americans are seeing an increase in spending power on average. Unemployment is low, and the stock market saw record highs last month. So why do so many Americans perceive the economy is doing poorly? John Diamond, director of the Baker Institute Center for Public Finance and a Rice University economics professor, is back on the podcast today to discuss how these traditional economic indicators are aligning or not aligning with how Americans are perceiving the economy. Is political bias at play? Are consumers truly better off or not than they were 4 years ago? Now, this is going to be a very timely discussion, and it will remain a key issue in this presidential contest until November. We're going to discuss all of this and more. I'm David Satterfield, director of Rice University's Baker Institute for Public Policy in Houston, Texas, and this is Baker Briefing. John, let's start with inflation. What does that rate of 3.3% tell us, and how does it compare to where we were 4 years ago in the lead up to the 2020 election, and why?
The number tells us that prices have increased 3% year over year, 3.3%. And in general, the Fed would like to target, what people think is normal is about 2%. So the Fed would like to see prices going up 2% every year, mainly because it wants to avoid situations in where prices are deflating or actually going down. So 3.3% is, that's a 50% increase over your target. It's a pretty large increase. Now, looking back over the past 3 years, it doesn't feel large because we just went through a period from May of 2021 to June of 2022 in which inflation, as you noted, hit 9.1% at its peak. So it's moderated substantially from that peak. And I think there is a feeling among consumers that they definitely recognize that that's a good thing. But then it plateaued at 3%. And an increase of 3% this year on top of an increase of 9% last year is a really big increase.
And I think, John, you're making a critical point that those of us who do international numbers are well aware of. Depends on what your base is.
Exactly.
So we had an unusually high base, that 9.1. And to put it into political terms, whose fault was that?
Well, can we blame any one person? No. So we'd have to go back and think about what factors affected inflation and is their fault to be doled out? Well, we had loose monetary policy. We had very loose fiscal policy. And some of that can be easily justified. The CARES Act, right after the pandemic started, it's hard to argue against, that kind of support for the economy. And the same for monetary policy at that point in time. But you roll forward a year, and Biden takes office and passes the American Rescue Plan. So we had $3 trillion already in the pipeline, and we come up with another $2 trillion, followed by the Inflation Reduction Act, followed by the Infrastructure Act. It's a lot of money for fiscal policy to ship into the pipeline, while at the same time, we know from the pandemic, we faced supply chain issues. We altered the way the world was going to exchange goods and that we were going to make more at home and buy less from abroad. But that means paying higher prices for the ones we make at home instead of the lower prices we were getting from abroad. And then we had these things called wars in Russia and now in the Middle East, which you've spoken a lot on. Those also impact prices of important goods such as oil. So it's a complicated network. There's a little bit of blame to go around everywhere. In the pandemic, did we really need, we don't want to be Captain Hindsight here. The political move was to shut things down. That's a hard decision to make. I'm not criticizing that decision. But 6 months later, when we had gotten things, we had come up with a vaccine, or at least we're in the pipeline. maybe there's some things that we can say, well, that looking back, that wasn't the best decision, say keeping kids at home.
So, John, that was then. Right or wrong, it happened. What are the tools that the president, that those who set fiscal policy and the Fed and monetary policy have in front of them now to address these challenges? Can we do more than just keep it static at 3%? Is there a way to genuinely bring inflation down in real terms, not just on that very high base?
And that is a very tricky issue. And it gets to this idea of people's uncertainty and their fears. So when we think about the Fed has done a lot. In the course of less than a year, they raised their baseline rate from 0 to 5.25. That's a tremendous amount of action. And that action has been working. Now, there's a real potential cost to raising the rate more. The Fed is trying to engineer the so-called soft landing, where the economy just never tanks. It never, nosedives off the cliff, and it just slowly glides into kind of its steady state growth rate. And so far, a lot of people think it looks like we could be doing that. But if you put another rate increase on the table in order to get inflation from 3% to 2%, you could very easily push the economy over the edge. In fact, if the Fed just waits too long to initiate its first rate cut after its raising cycle, it could throw the economy off the edge. And I think that's a lot of the fear that we see from consumers. So when you look at the latest consumer sentiment report, the two big factors that were affecting consumers were inflation and fear of losing their jobs. And I think everybody recognizes that there is this potential for the fight against inflation to turn into significant unemployment numbers, which we haven't seen yet. So far, the labor market has come to the rescue. We have had a very solid and strong labor market producing a lot of jobs. In the last 12 months, it has produced increases in wage rates that have been larger than the increases in prices. And so we got some gains in real wages. But remember, that followed a period where real wages lagged significantly. And while there are positive data points that we should look at and say, well, boy, consumers should be really positive about this. GDP has increased. The S&P 500 is up 28% in the last 9 months. Unemployment is historically low. Those things are good. And those are data points that should give consumers a positive feeling. But on the other side, you've got real wages. So real hourly wages are just barely up from January 2021. And if you look at real average weekly earnings, they're down since January 2021. So whereas the amount you get paid on average is up, the amount you bring home in your weekly paycheck is down in real terms. So that's a negative for consumers that they're definitely going to see and feel. And then there's a bunch of other negatives.
Yeah, and talking about those bunch of other negatives, many, many Americans took advantage of historic low interest rates to purchase homes or refinance mortgages. And that in turn spurred the real estate market, the job market associated with it. Rates are up now. What's the impact as you factor all things into the economy of the housing market?
The housing market is having a big impact, and I think it's also having a big impact on people's psyches. So, the first problem with higher interest rates is they raise the cost of buying a house, obviously. If your mortgage rate, if your interest rate is high, then your principal and your interest payments are going to be really large, meaning your principal and interest payments will be really, really big. But when high interest rates followed historically low interest rates, you get a phenomenon where people are sitting on rates that they don't want to give up. And so they're locked in their current house, whether they get a new job across the city or just want to get a bigger house because their family has expanded, or they're just, they only bought that house temporarily and they're ready to move, they're locked in. They're not going to sell because selling means doubling your mortgage payment. So those people feel like they don't have a choice, although they love the position of having a really low mortgage payment. On the other hand, people that are out looking to buy houses, they're running into the problem that no one's selling. So supply is low. Demand has stayed pretty firm. And so we get price increases, which have been happening like clockwork for the last year and a half.
And let's talk about the investment market. You're an investor. You have cash available. How does the state of the economy and uncertainty over future direction impact your rational actor? Because we'll talk about rational actors here. Decisions. What do you do with that money? Where does it go right now in terms of putting it aside into high interest generating instruments, into economic ventures? Where does it go?
That has changed significantly in the last 2 years. Prior to this, there was no yield in putting money into a high yield savings account or even thinking about buying bonds. You were just getting nothing. And so everybody chased return in stocks and in real estate. But one thing with higher interest rate is all of a sudden there's a sizable return to be had by putting your money into really safe assets like CDs and short-term treasury bills. And so that's actually been one of the positives is people have been able to rebalance their portfolios into safer assets and still get pretty good returns. But that doesn't speak well for people making investments in things such as housing, which before we saw people doing a lot of investing in housing and flipping the houses and trying to make profits. That's not the environment we're in right now. Right now, we're in an environment where people that have houses generally don't want to sell them because they're sitting on really low mortgage rates. And people that want houses, A, they can't find a house because the supply is really low. And B, if they do, the cost is very large given the high interest rate they have to pay. And at first, people were saying, marry the house and date the interest rate, i.e. you're going to buy a house, you wait a couple of years, and then you refinance, and your interest rate is low. But the longer this interest rate stays high, I think the more people say, wait a second, I'm just going to sit on the sideline a little bit because this doesn't look right.
I like that phrase. Marry the house, date the interest rate. So we've talked in the past about the president's toolbox. What can a president do at a time like this? Is it hands off? Is it hands on? What's the right policy course?
So right now, you asked if there was a political bias. There's always a political bias, but it usually evens out because those on the right support the policies of the right and those on the left support the policies on the left. I think the bias is a little different right now. I think in general, there's a negativity bias. And this is actually just psychology finds this. If you have an athletic endeavor, like golf, we're much more likely to remember the negative things that happen to us than the positive. And it actually takes hard work to get your brain to recognize the positives and to focus on the positives so that the next time you have that pressure-filled moment, your brain doesn't go to the negative. I think that's happening in the economy. People, they see lots of positives around them and things have been positive, but what's on the forefront of their mind is that negative they remember. Boy, what if inflation comes back? Or what if the job market falls apart and I lose my job? Those fears have been bringing down consumer sentiment. And I think that's one of the reasons there's the current economy and consumer sentiment just don't match. And I think it's those fears that are driving that.
Do we need, given all of this, better, different metrics to judge what we call consumer confidence or consumer sentiment?
Maybe we can line up the metrics and the sentiment different, but I think more than anything, we just always have to be aware. And people are complicated. I'm not sure we'll ever have a perfect metric. But getting back to the political question, The other negative I think people have on their plate is we hear about the problems, 35 trillion in debt. And looking forward, it looks like the latest financial document of the United States, financial report, says there's another 75 trillion coming in the next 75 years. So that's 110 trillion in debt.
And remind us of how much interest, debt payment constitutes in terms of GDP.
This year, we're going to be real close to $1 trillion in net interest payments, maybe just under $1 trillion, right around 900. That's a lot of money just to pay interest. That's the money you spend and you get nothing for it. You're simply treading water and you don't get to consume anything for that payment. So I think consumers hear these numbers and they see these numbers and they make the rational call that, oh, I'm going to end up paying part of this debt. And I think that's one of the fears. And unfortunately, politically, and we can spread this blame very equally, there are no solutions being offered. In fact, it's the opposite. One side wants to spend and one side wants to cut revenues. Neither gets us closer, only further away.
And so, John, the $64,000 question, or I guess with inflation, it's now $1 million question. Are we, at least in terms of quantifiable metrics, better off today than 4 years ago? Take your time.
Yes, I am going to dodge this question like any economist would. Some of us are better off and some of us are not. So we could go through. High-income people with technical skills are likely doing better, but not all of them. So research from the past week has showed that even people making between $150,000 and $200,000 are worried about making ends meet. And that's 32% of people in that income category are worried about making ends meet. But yes, they're probably doing better than some of the lower income groups. You know, when we think about families and homeowners, well, they're better off if they're sitting on a low rate mortgage and they're in a house they want to live in and its price is going way up. That's good for them. Retirees are probably doing okay because if you got your nest egg and all of a sudden you can get 5% on a safe return, well, that's better than where you were 4 years ago, more than likely. Young kids, boy, COVID really took the sail out of education, and we're still trying to make up for those losses. And I think that's a problem. And I do think that's been impacting some of the younger people in this country and the families that care about their kids and their kids being educated. And they see these struggles that have kind of been put in their way. And then when you think about the government spending, so the government put a lot into education in 2023, into 22 and 23, and all that money is drying up. There was all this COVID money. They spent a lot on education that they don't normally spend in order to help the schools through COVID. Well, as that money dries up, schools are looking at having to cut back on services they've been providing. That's a tough place to be. That's parents don't like that. Parents like to see their kids getting a great education, having resources to do that. But we get back to that question. We're also facing a $2 trillion deficit this year, according to the latest CBO numbers. We can't spend money on everything. There's got to be some fiscal discipline. All of those things, some people are worse off, some people are better off. At the end of the day, it depends on who you are and where you sit.
But John, I think the most trenchant bottom line is cutting spending, cutting revenues, just continuing to increase spending. None of these are going to address the question we'll be asking 4 years from now. Where were you 4 years ago? Do you feel you're better off or not?
That's correct. At some point, we got to make some better fiscal decisions.
Lines have got to meet in space, in a good place, or they're going to meet in space in a bad place.
Very true.
Baker Briefing is brought to you by the Baker Institute for Public Policy, which provides meaningful, nonpartisan policy analysis on the most critical challenges facing Texas, the United States, and the world. It is produced by Victoria Jupp, Shannon Moriarty, and Karina Zamel. AV production is led by Kevin Young. Be sure to visit us at bakerinstitute.org to learn more. Thanks for listening.